Welcome to Tax, Retirement, Investment, and Insurance Planning Strategies and Solutions, or TRIIPSS. My name is Peter Wouters, and today's sessions will be covering off individual pension plans, Part 2. On today's agenda, we'll once again spend some time on differences between a registered retirement savings plan compared to an individual pension plan, and why the latter may have greater appeal to business owner-managers and key persons. I'll be covering off benefit options at retirement, at death, or even wind up. What happens if there are business changes or affordability concerns? And finally, I'll spend a little bit of time on setup and administration considerations. So again, let's look at the differences between a registered retirement savings plan compared to an individual pension plan. There are a number of advantages of an individual pension plan over a registered retirement savings plan. One are higher contribution amounts. Someone age 55, for example, with full pension and past service back to January 1st, 1991, and maximum earnings, could expect to accumulate more than 50% additional savings using an individual pension plan versus a registered retirement savings plans at age 60, 65, or 71. That's quite a spread, 50%, more than 50% additional savings. Past service provided must satisfy, of course, the past service pension adjustment or PSPA requirements. And again, for past service, a connected person is someone that owns more than 10% of the shares of a company, and they can only go back as far as 1991. Non-connected persons, of course, can go back as far as their date of hire. There's expanded credit protection. Now, while credit protection exists for registered retirement savings plans, there are limitations. And I covered part of this off in Part 1 of individual pension plans. The Bankruptcy and Insolvency Act exempts registered retirement savings plans from seizure by creditors except for any contributions made within the last 12 months to a client or spouse's plan. And that's covered under Section 67(1) and B3 of the Bankruptcy and Insolvency Act. And there's also the issue of fraudulent preferences. The Act also states that creditors are not entitled to any assets that are exempt from execution or seizure by provincial law. Trustees have no more rights to access funds than the plan holder, including recent contributions. Trustees cannot seize what the plan holder cannot withdraw. Insurance regulations generally provide creditor protection for registered retirement savings plans where specified family members are named as beneficiaries. For example, the Insurance Act of Ontario protects RRSPs that have a life insurance component if the beneficiary is a spouse, parent, child, or grandchild. Other provinces may have the same exception or one that's similar. In Ontario, a registered pension plan is governed by the Ontario Pension Benefits Act and as such may be exempt from seizure in a bankruptcy. Ontario protects company-sponsored or government-sponsored registered pension plans. All pension assets under these plans are protected, regardless of when the contribution was made. That includes your contributions and company contributions, even if they're made within the previous 12 months, as well as any locked-in accounts. Interest on funds borrowed for contributions are tax deductible. Contributions can be made within 120 days after the corporate year end, and there's no deemed disposition of plan assets on death. There are other advantages over a registered retirement savings plan. Expenses are tax deductible. Plan surplus generally belongs to participants. They're not subject to provincial payroll taxes in Newfoundland, Quebec, Ontario, and Manitoba. And there's the ability to make further tax-deductible contributions if the plan is underfunded. And the most likely source of the deficit, well, the net investment rate of return actually earned in the investments is less than the 7.5% per annum calculation that's used to define how much of an asset is going to be required to provide that defined benefit at retirement. So setup costs, ongoing administration costs and fees, the cost of monies borrowed to fund an individual pension plan are all tax deductible when they're paid by the plan sponsor as opposed to the plan itself. So the plan sponsor needs to pay for this in order for the deduction to actually apply. Let's compare contributions and withdrawals. In terms of contributions, there are limited amounts of money you can put into a registered retirement savings plan. That exists for an individual pension plan as well, but the contributions after age 40 are going to be higher for an individual pension plan compared to a registered retirement savings plan. In terms of withdrawals, you can withdraw as much as you want into a retirement savings plan, recognizing, of course, that it's going to be taxes on every dollar you take out. And withdrawals under an individual plan at best are limited. At best are limited, and they're governed by provincial legislation that handles pension plans. A person to be covered under individual pension plan should not make an RRSP contribution in the year that the individual pension plan is set up. The assets of an individual pension plan must be used to provide a pension. They cannot be used for other purposes, like a home buyer's plan or to fund a vacation or a home renovation. If that's what you want to do, then a rich retirement savings plan has the edge. A member has no access to the plan while employed and is a member of the plan. Benefits are locked in with an individual pension plan. On the departure of the employee or on the plan windup, assets need to be moved to a locked-in retirement account. And there are some federal and provincial unlocking rules that may apply, as I mentioned earlier. Contribution amounts to an individual pension plan may be limited if the invested assets are doing well and generate an actuarially determined surplus. Now, that wouldn't happen with a rich retirement savings plan. So that may be good or bad. It's good if the company has some cash flow problems or wants to redirect monies to some other purpose. It's bad if the company is counting on getting a deduction to stay below the small business limits for income tax purposes. Here's a comparison of a rich retirement savings plan versus individual pension plan in terms of the first year contribution advantage at various ages, 40 up to 62. And this assumes the member earns about $151,000 and has service back to 1991. As you can see, the contribution limit for an individual pension plan is substantially more than it is for a rich retirement savings plan contribution once you include past service. So the individual pension plan advantage in 2019 for someone that earns $151,000 and has service back to 1991 ranges from $97,000 at age 40 to over $500,000 at age 62. And the assumptions used here are that you're looking at an individual again who's making around $151,000 a year, who's got service back to 1991. When you compare annual rich retirement savings plan contributions versus individual plan contributions, again, we're looking at a comparison in favor of individual pension plans. From age 40 to age following year, $27,230 at age 40. That would be compared to $29,500 in 2020 at age 40. In 2021, the individual pension plan contribution jumps to $31,800 and $34,106 to be precise in 2022. And that's outstripping the amount of money that you could put into an RRSP. That jumps quite a bit to age 60. We're looking at, again, the same maximum RRSP contribution in 2020. I know that it's indexed, but it's $27,230 at age 60. Compare that to an individual pension plan. Same year, $43,000 compared to $27,200. $46,300 compared to $27,200, and almost $50,000 in 2022 compared to $27,200 into an RRSP. If we did this in terms of percentages, recognize that RRSP contribution room is based on 18% of your prior year's earnings. IPP contribution room varies by age and amount. 20% at age 45, jumping to 29% at age 65. It falls off a little bit at age 70, down to 26%. So again, significant differences in terms of percentages, and the percentages may be easier to remember than the actual dollar amounts. If you would like handouts of this information, then please contact your account executive and we can get a handout version of this to you in your hands. Pictures say 1,000 words. And again, you've seen this in part 1 of individual pension plans. Again, assuming that you're dealing with a 45-year-old earning about $140,000 a year, that's increasing about 5% per year. They've got 10 years of past service. The stipulated rate of return, of course, is 7.5%. And there's going to be a 3% payment indexing post-retirement. So if you're going to be indexing payments post-retirement, do you want to be looking at the RRSP number in gray, or do you want to be looking at the IPP number in blue to kick off your retirement income? Graphically, again, this is looking at it slightly differently, comparing an RRSP in blue to the IPP Advantage, and the IPP Advantage here to someone here starting at age 56 with past service is over $500,000. The ideal candidate, as I said, is typically someone between the ages of 40 and 45. Why? Because at that point in time, the amount of money you can put into an individual pension plan starts to outstrip the contribution limit for a rich retirement savings plan. And the target ages, though, could be age 40 to 45, but most of the candidates that we see are typically over the age of 50. The IPP contribution amounts increase with age, so that the older the individual pension plan member becomes, the greater the advantage over the rich retirement savings plan contributions that are available. Now, there are a number of advantages of individual pension plans over rich retirement savings plans. The main one being, of course, the ability to tax shelter a greater amount of money. As I said in Individual Pension Plans Part 1, the one I want to focus on here again is one of the greatest advantages of individual pension plans. In fact, before the private corporation tax proposals came out, this may have been the niche where individual pension plans really made sense in the face of higher rich retirement savings plan contributions over the years, and where administrative fees were eating into some of those advantages. And the scenario here is when you're looking at multi-generational plans, or plans specifically where you're looking at a parent passing on the business to a child. It's ideal there for family businesses. There's no need to wind up the individual pension plan on the retirement of the parent. Future generations can join an existing plan if they're employed by sponsoring companies, and the death benefit after the survivor of the first generation retires leaves assets in the individual pension plan to fund the children's pension plan who have now taken over the business. So the value is not lost. A business owner may be interested in keeping the business in the family and passing it on to an interested and capable child. If the business owner's corporation continues after the primary owner retires or passes away, the family member who takes over can be added as a member of the individual pension plan. Assets not used to provide benefits for the parent can remain in the plan and be redirected to provide retirement pension benefits down the road to the child on a tax-sheltered basis. So the member, the spouse, or the beneficiary of the estate will receive benefits. And those IPP, individual pension plan assets, can be paid to the member as a pension benefit, to the spouse as a survivor benefit, or the estate or beneficiary of the last survivor as a lump sum residual. Let's consider benefit options. What happens at the other end of the line? And we'll consider termination or retirement. Retirement income may begin as early as age 50, but practically speaking, most plans are set up around that time with the intent of beginning pension income much, much later. The Canada Revenue Agency announced that it would not require amendments to payout regulations dealing with individual pension plans where an annual minimum account must be withdrawn for members over the age of 71. The calculation of this minimum amount is similar to the minimum withdrawal calculation for rich retirement income funds, which is based on the member's age and the market value of the plan's assets each January 1st. The amendments won't be required if the plan is subject to pension standards legislation and the relevant regulator refuses the amendment. The amendments address the requirement that income must begin no later than when the member turns age 71. That said, most plans will be set up to provide a defined indexed pension benefit that will operate more like an indexed annuity, so this should not be an issue. So the pension is paid from the fund. It can be used to purchase an annuity from an insurance company. It can be paid out as a lump sum and transferred to a locked-in vehicle like a life income fund or a locked-in retirement income fund. You can only transfer an amount up to the maximum limit allowed by tax legislation. Excess amounts are paid in a lump sum that's taxable as a cash payment or as a pre-age 65 benefit. And the guaranteed minimum withdrawal benefit may be an appropriate investment product fit at that point in time. Talk to account executives about how that might work. Let's look at again these benefit options. The spouse can be named as the primary beneficiary both before and after retirement, unless a spousal waiver is signed, and that's typical for pension plan benefits. Pre-retirement, the spouse would be options would be to roll the money into a locked-in retirement account or an RRSP, depending on provincial legislation, or taking a taxable lump sum payment. If there is no spouse, the beneficiary or the estate, depending on the beneficiary election, receives a lump sum payment representing the member's individual pension plan account. Post-retirement, the spouse's options include an immediate or deferred survival benefit payable as if the member was deemed to have died one day before death. A lump sum payment can be made representing the actuarial equivalent of the member's pension at the time of death to a locked-in retirement account or RRSP, again, depending on provincial legislation. If there is no spouse, again, the monies can be paid to the beneficiary or the estate, depending on the beneficiary election, who can receive a lump sum payment representing the member's individual pension plan account. The commencement of the pension could be the spouse's option. The election can be made at retirement, and it usually would represent 66 2/3, including any guarantee period paid for the life of the surviving spouse. If there is no spouse at the time of death, the beneficiary or the estate receives a lump sum death benefit representing the account balance of the individual pension plan and would be taxed on that money. In terms of beneficiary options, you could name your spouse or common law partner as the main beneficiary. Adult children can be named to receive equal benefits. Children under the age of 18 should not be named as a beneficiary of individual pension plan, but when the youngest child attains age 18, beneficiary designations can be changed. On marital breakdown, pension assets are treated as matrimonial assets like a rich retirement savings plan and may be divided between the member and the spouse or common law partner. Or you can assign a value in kind. So instead of actually assigning that pension benefit, you could find some other asset that valued about the same amount of money, and you could transfer that to the former spouse and keep the pension plan intact. Now, what happens if there are business changes and affordability issues? Specifically, what if the business doesn't do as well in the future and can no longer afford scheduled individual pension plan contributions? Again, the caveats are the solutions presume the plan is for the business owner, and the solutions require amendments or a wind-up work by the actuary. And again, plan amendment costs and wind-up costs could range between $2,500 and $3,000. So under solution 1, you can amend the plan to freeze the benefits for a given year. Solution 2, you can amend the plan to reduce the benefit that a business owner has promised himself or herself. Because typically these are set up for the business owner themselves. You're not arguing with a key employee, you're dealing with a business owner who has set this thing up for himself or herself. Under solution 1, you stress test how the generous funding of an individual pension plan has generated taxable excess, and perhaps increased tax shelter receipt to date may far exceed the basic RRSP limits, so you still could be ahead of the game. Under solution 2, you use the excess as income in the first years of retirement or to pay for a long-awaited vacation, cottage, a boat, or something else. Under solution 3, you could wind up the plan, and that, of course, would cancel any future benefits. You could alternatively use a portion to purchase an annuity and a portion to purchase a life income fund or a locked-in RRSP to alleviate some of the taxable excess, which can be matched to income needs in the first years of retirement. You could also leave the pension fund open and draw pension income from the fund if there's especially if there's a new or successor owner of the business in the agreement. The affordability challenge may also appear when doing terminal valuations and the plan sponsor finds that the plan is underfunded, perhaps significantly so. This is why it's important to pay attention to the asset value and make sure the plan is fully funded. Here again, consider the solutions I just covered. Unfortunately, these options may not be available to non-connected members and beneficiaries of a connected member. There are now questions whether a connected member can agree to a benefit reduction after they have retired. Let's look at individual pension plan income options. 1, winding up the individual pension plan and transferring it to a locked-in retirement account. 2, purchasing an annuity. Or 3, maintaining the individual pension plan. In winding up an individual pension plan and transferring it to a locked-in retirement account, the individual pension plan is terminated. Part or all of the accumulated assets are transferred to the locked-in retirement account, and the balance of assets are paid as taxable income in the neighborhood of 33 to 45% of that money. Normally, it's paid to the employee, possibly to the employer. The surplus on wind-up normally belongs to the employee. It's taxed at the top tax bracket, even though the corporation only say perhaps 16% or 32% tax on the contributions. An option could be to purchase an annuity. The annuity can be based either on the plan member's life. It can cover the life of the plan member and a spouse or common law partner, so a joint annuity. The setup would be a joint and last survivor plan with payments that may or may not reduce by a set percentage on the death of the first person. That, of course, is determined when the annuity is selected. In either case, a minimum guaranteed payout period may be added so that payments will continue to a named beneficiary for a minimum period of time, even if a plan member and spouse or common law partner die early. And if an annuity is purchased, an additional contribution may be required if annuity interest rates are less than 7.5%, which of course would be tax deductible to the company. Considerations: what's the interest rate at the time? How easy it's going to be to liquidate those assets? What are some of the income tax implications? What about estate values and that extra cost of perhaps setting up an indexed annuity, which could amount to much as 30% more money? Third option is to maintain the individual pension plan. Investments remain intact. The member avoids the tax hit from the transfer out. Income is paid from the individual pension plan to the retired employee. The surplus may be retained. The excess surplus must be withdrawn and taxed to the employee. Assets exceeding 110% of plan liabilities, of course, and deficits, of course, must be funded by an employer. Remaining assets of the death of the employee can be transferred to a locked-in retirement account or RSP of the spouse, where the balance is paid as taxable surplus, or it could be used to fund the retirement or a successor owner child. So a successor owner child could have stepped in, and whatever is left is not paid out to the spouse. It's actually left in there as a kickstart for the adult child who's now taken over the business. What happens if the company is sold and there's an interest about maintaining the individual pension plan? Well, the purchaser will not assume the ongoing liabilities. That may be an option. They may assume the liabilities, they may not. So the alternatives that occur, the purchaser will not assume the ongoing liabilities, are to wind up the plan and transfer it to a locked-in retirement account, to purchase an annuity, or transfer the individual pension plan to another company. But again, if you're going to do that, note the federal budget 2019 restrictions that I talked about in an earlier session. The problem is that if the company is sold and the individual pension plan assets generally exceed the maximum transfer value, the kind of revenue agency will deny the transfer of the individual pension plan if the sole purpose of the transfer is to avoid paying tax on the surplus, and the employee is not employed by the new company. The new individual pension plan is excluded from providing benefits for past service and prior years that were covered by the defined benefit registered pension plan of a different employer. And that, of course, was covered under federal budget 2019. Now, let's consider the members of the professional team that can help set up one of these plans for a client. They would include the investment manager or advisor, an accountant, actuaries, legal counsel, and a trustee or custodian. So here's the consideration for individual pension plans. The plan administrators will either need to A, set up a formal trust, and a formal trust must consist of at least 3 individuals who reside in Canada, and one of whom must be independent of the company that sponsors the individual pension plan, and that's applicable in some provinces, so that independent third person could be the outside accountant. It could, in fact, be the actuarial firm. B, the second option, is to have the account, though not necessarily the funding, set up with a financial institution that offers corporate trustee services. And not all financial institutions like banks and trust companies offer these services. For example, B2B Trustco formally resigned as corporate trustee for all individual pension plan accounts effective November 16, 2017. Plan administrators had to look to option A or B to continue their plans. And if it was A, set up a formal trust of at least 3 individuals who reside in Canada with the stipulations that existed with that, or move that account to another bank or another financial institution who had corporate trustee services. And here's a note on using actuarial firms, which we'll talk about in a minute. Independent actuarial firms provide setup, actuarial, and ongoing administration services of the plan. They may be named as one of the 3 trustees under a self-directed trust, but they are not involved in the management of the pension assets. That role generally falls to the financial advisor working with a sponsoring company, the owner manager, and the plan administrator. And although you hear me use the terms sponsoring company and plan administrator, the plan administrator, the plan sponsor, are the company that sets up the IPP for the member. So you're dealing with an individual who's a business owner, and it's that business owner's company that is the plan administrator and the plan sponsor of the individual pension plan. Here are some other individual pension plan and retirement compensation arrangement key considerations. First off, there's a general order of process that people should consider when looking at individual pension plans and retirement compensation arrangements. Choose the individual pension plan first and use the retirement compensation arrangement to top up benefits available from the individual pension plan. If a retirement compensation arrangement, or RCA, is viewed as being inappropriate, Empower Life can assist in providing insured retirement strategy support in cooperation with the client and advises other professionals such as accountants, lawyers, and trustees. So speak to our account executives on the insurance side about how that strategy actually works. But what does the client really want to do in terms of ongoing investment decisions, in terms of flexibility in selecting portfolios, in control over those decisions, in involvement in overseeing administration? So which do you choose, and in what order? There are, of course, other alternatives: insured retirement programs, or even leveraged loans via life insurance. Do comparisons cover all costs? If you're selecting trustees and an accountant is chosen, you need to add the annual fees. So cheap at really $1,000 a year for the accountant, but will it be done properly? And what is the accountant's familiarity with forms, filings, and requirements, let alone the other two trustees? When you're choosing amongst providers, and by that I mean the third-party actuarial firms, is everything covered? Small things can add up to aggravation, errors, costs, and stress. And your client's familiarity with filings administration requirements will also play into which firm may want to do the job, or how much you may want to outsource to a firm to do that work for you. And what about errors and omissions coverage for the advisor? So again, is everything covered? Because small things can add up to aggravation. And again, I'm talking about providers at independent actuarial consulting firms who offer service and support for individual pension plans. In terms of the setup, advisor can make a request, a personalized quote via Empower Life, but typically will make it directly to a third-party provider. They can complete a questionnaire for each provider, and it's done at no cost. There's a registration package that can be available via that third-party provider, where you would complete the forms, you sign the individual pension plan documents, and who would help with the registration with the Canada Revenue Agency and the provincial authority, if applicable. And then the advisor, of course, together with the plan sponsor, the employer, the business owner, would select the fund investments, complete the investment applications, and submit the money. The plan, of course, is owned by the sponsoring company, actually the trust. It's held in trust by trustees on behalf of the plan members and their beneficiaries, and quotes are provided by third-party actuarial consulting firms offering pension services and may be requested through Empower Life, although typically they go directly through that third-party provider. In terms of annual administration, these are some of the considerations that you have to keep in mind. You need to provide an account summary. The advisor or the accountant or trustee, and at the beginning of the year, will provide an account summary that contains any information about RRSP transfers into the individual pension plan, company contributions made to the individual pension plan for the calendar year, employee and member contributions if permitted, the value of the plan assets at December 31st, portfolio holdings at December 31st, and investment, management, and actuarial fees, as well as any pension payments that have actually been made. There's the pension adjustment, which is related to the employment earnings reported on box 14 of the T4 slip. That's required to be reported on box 50 of the plan member's T4 slip, and the individual pension plan registration number that's reported on box 52 of the T4 slip, all important for the plan administrator. There are also filings. The T3P employee's pension plan income tax return that needs to be filed, the pension fund financial statements, the annual information return to the Canada Revenue Agency, and FISCO, if applicable. And FISCO, this is for Ontario plans, so would complete Form 7, would have a summary of the contributions actually made. Now, the plan sponsor, the company, needs to include a pension adjustment and the plan's registration number on each active plan member's T4 slip. And the reported pension adjustment is used by the Canada Revenue Agency to adjust the personal RRSP room. That's the reason for all of this. It's important to note that the pension adjustment is not equal to the annual individual pension plan contribution. To obtain pension adjustment information prior to corporate T4 filing deadline of February 28th, the sponsoring company can complete the pension adjustment form and submit it to the third-party consulting firm who does the calculation and confirms the individual pension plan information that is to be included on a plan member's T4 slip. So there is an advantage right there for actually outsourcing some of this work instead of having the 3 trustees do it all by themselves. Unless, of course, one of those trustees is that third-party actuarial consulting firm. So let's consider professional third-party alternative benefits. Individual pension plans are in an area where advisors and business owners should seek out and retain specialist advice. That includes independent actuaries and accredited pension specialists, as well as accredited tax, retirement, and estate planning specialists. And what's more, this should be undertaken as part of a comprehensive retirement plan and retirement income planning. Prudent advisors and business owners should engage in these processes, and advisors should take advantage of the detailed program of retirement income planning that Empower Life offers. Again, talk to our account executives about how you may be eligible for taking part of this plan. Now, most of the error and omissions worries about coverage are gone since the advisor is typically not involved in administration of the individual pension plan, the filings, the reporting, the evaluations, etc. Marketing and training support, including case consultation provided, in our case anyway, can be provided by Empower Life's tax, retirement, and estate planning team. And here are, this is not an exhaustive list, but again, if you ask for the handout from your account executive, you can get this thing. Here's the contact information of some of the major players that provide independent actuarial consulting services dealing with individual pension plans. We've got Gordon B. Lang, or GWL, Eckler, which of course is bilingual. They've got offices across the country, but this will be very, very important, of course, in New Brunswick and Quebec in particular. We have LMC Group, Lesniewski Moore Consulting Group, Incorporated, again, with their offices in out west in Alberta, Manitoba, and Toronto. And Millette Actuaries, again, bilingual, that offer Quebec-based multiple locations for individual pension plans and advisors and staff looking for support in that area. There are West Coast Actuaries that is really an online service that have offices in British Columbia, but can deal across Western Canada, perhaps even Eastern Canada as well. And Morneau Chapelle, which offers bilingual service as well, and may be able to support you with individual pension plans. In terms of structure and administration, consider Empower Life's guaranteed investment funds and emblem portfolios, and speak with your account executive about features and options that may work best for a particular situation. You can mix and match portfolios. We're assuming, of course, that Empower Life will get part of the investment business. The client or designate can remain more involved if desired. For typical cases, work and administration, outsourcing is scalable. Most may be done by an independent actuarial consulting firm. It's priced according to the amount of work that's passed on to them. And signatures to some documents are also prepared by the consulting firm so that the other trustees simply have to sign the forms. Empower Life, of course, would need direction from the trustees on investment allocation and payouts at the other end, either from the advisor or directly from the trustees. Here are the top 10 reasons to choose Empower Life Guaranteed Investment Funds. Just a quick look and a quick guarantee. There's a choice of guarantees. There's a range of investment options, Canadian and global, from bond funds up to 100% equity funds. You've got access to the emblem portfolio. It's available in fast and full investment applications, our industry-leading segregated fund electronic app. You can offer your high net worth clients preferred pricing starting at $500,000 per household, which can be significant when you're looking at past funding and past service funding. You can get up to that $500,000 pretty quickly. This product provides automatic annual death benefit guarantee resets to age 80. Compensation may be done your way with front end, low load, no load, deferred sales charges, and fee for service. Empower Life, of course, has been managing money for over 50 years using a conservative, value-oriented, and disciplined investment approach with an emphasis, of course, on downside protection. There are market opportunities. Empire Life's Guaranteed Investment Fund has features that are attractive to younger markets, as well as the over age 80 group in terms of both benefits and strategies like ageless investing. Solutions can be structured as well to benefit younger markets in the over age 80 group, combining investment planning with investment planning and wealth training strategies. Some of these benefits, of course, aren't applicable to individual pension plans, but something you need to keep in mind when you're looking at Empire Life as a preferred provider. We'll again speak with our account executives about product and strategy details. There are also some other alternatives you should consider. You may consider stacked marketing strategies approach and integrating them and optimizing executive retirement programs. For example, if a retirement compensation arrangement is inappropriate, Empire Life can assist in providing insured retirement strategy support. Keep in mind, of course, that setting this up with formal documentation could cause the Canada Revenue Agency to categorize this as a deemed retirement compensation arrangement. So that's just a caveat I just put out there for you. Again, speak with your account executive at Empire Life for details on optimal cash value life insurance products that may be used effectively for the insured retirement strategy. So let's quickly review the key elements of an individual pension plan. One, it's a defined benefit pension plan governed by pension benefits legislation. It's registered with the Canada Revenue Agency. Contributions are deductible for income tax. Of course, so are all expenses associated with the plan. The employer assumes all statutory and regulatory requirements of the plan, but can defer the administration of that to a third party. Benefits can be provided for services after 1990, and the surplus in the plan typically belongs to the employee. Finally, and you've heard me talk about guaranteed lifetime income benefits, another advantage of an individual pension plan is that it can provide predictable lifetime income. Thank you for listening to part 2, and of course, parts 1 and 2 should give you a very good grounding for dealing with clients and looking at opening doors for individual pension plans. And Empire Life is right here to help you out and make those plans bear fruit.